Hello, traders, and welcome to the exciting world of Forex. If you're ready to dive into the dynamic, fast-paced realm of currency trading, then you've come to the right place. This book is your ultimate guide to everything you need to know about Forex trading, whether you're a complete beginner or looking to refine your skills. From understanding the basics of currency pairs to managing your trades and emotions, we cover it all in simple, straightforward language. You'll discover powerful strategies, risk management tips, and the tools to build your own trading system. Plus, we dive into important concepts like market liquidity, technical versus fundamental analysis, and the importance of trading psychology. If you find this guide helpful, don't forget to like, share, and subscribe for more trading tips and strategies. Let's get started. Your Forex success story begins now. Chapter 1. Welcome to the world of Forex trading. Let's dive right in and discover the exciting world of Forex trading together. What is Forex? Forex is short for foreign exchange. You might also hear it called FX trading or currency trading. It's all about trading the currencies of different countries. Now, this isn't like trading stocks or shares. It's a little different. In Forex, you're not just buying or selling a single currency. You're trading one currency against another. For example, if you're trading the euro EUR against the US dollar USD, you're essentially asking, how much is 1 euro worth in dollars? It might sound complex, but trust me, it's simpler than it seems. Why would you want to trade Forex? Good question. You've probably heard of people trading stocks or maybe even options. But Forex? That's a whole different game. Until about 15 years ago, Forex trading was mostly for banks or wealthy individuals. But thanks to the internet, it's now open to everyone. You, me, and anyone with a small deposit to start with. Here's what makes Forex special. It's fast, it's global, and it's available at your fingertips. With just a few clicks, you can trade online. This accessibility is what's fueled its boom in popularity. Why Forex? Let me give you some perspective. Forex is the most liquid market in the world. It runs 24 hours a day, 5.5 days a week. How big is it? In 2014, the average daily trading volume hit $5.3 trillion. Yes, trillion. That breaks down to about $220 billion every hour. To put that into context, the New York Stock Exchange would need 30 days of trading to match just 1 day of Forex trading. Crazy, right? But what does this mean for you as a trader? Liquidity. Simply put, there's always someone to trade with, and the market is always moving. This constant activity creates opportunities around the clock. When is the Forex market open? Unlike stock markets that follow specific hours, the Forex market never really sleeps. Thanks to its global nature, it's open 24 hours a day, starting in Asia, moving to Europe, and wrapping up in North America. From Monday morning to Friday evening, you can trade at your convenience. Imagine the freedom. No waiting for markets to open. No stressing about closing bells. You trade when it suits you. Forex trading offers flexibility, massive liquidity, and accessibility like no other market. It's no wonder people are drawn to it. So, are you ready to explore the world of Forex? Stick with me, and let's turn that curiosity into confidence. Chapter 2. What do we trade in the Forex market? In this chapter, we're getting into the nitty-gritty of what we trade, where we trade, and how to choose a broker. If you've ever looked at Forex charts and thought, what do all these numbers and currency pairs even mean? Don't worry, we'll break it all down for you step by step. So grab your notebook and let's dive right in. Forex pairs, what do the numbers mean? All right, here's the deal. In Forex, we trade currency pairs. Why pairs? Because when you trade Forex, you're essentially comparing the value of one currency to another. Let's take an example. EUR USD. EUR stands for the euro, and USD stands for the US dollar. When you see EUR USD, it represents how many US dollars USD you need to buy 1 euro. Currencies are always quoted in pairs because you can't measure the value of one without comparing it to another. It's like saying, how many apples can I buy with 1 orange? Now, these pairs are divided into 3 categories. 1. Major pairs. These are the most traded pairs in the world and include currencies like the USD, EUR, JPY Japanese Yen, GBP, British Pound, CHF, Swiss franc, AUD Australian dollar, and CAD, Canadian dollar. Major pairs always include the US dollar, making them the most liquid and stable options for traders. Examples, EUR-USD, USD-JPY, and GBP-USD. 2. Minor pairs. These are currency pairs that don't include the USD but involve other strong currencies like the EUR, GBP, or JPY. Examples, EUR-GBP, GB-JPY, and AUD-NZD. 3. Exotic pairs. Now this is where things get interesting. Exotic pairs involve one major currency and a currency from a smaller or emerging economy. Think USD-TRY, US dollar versus Turkish lira, or EUR-ZAR, euro versus South African rand. These pairs are less liquid and more volatile, so they're riskier for beginners. When you look at a currency pair, the first currency is called the base currency, and the second is the quote currency. If EUR-USD is 1.10, that means 1 euro equals 1.10 US dollars. Simple, right? Where do we trade Forex? Now that we know what we're trading, the next question is, where does all this trading happen? Here's the cool part. Forex doesn't have a centralized marketplace like the New York Stock Exchange. Instead, it's traded over the counter, OTC, meaning all transactions happen electronically between traders via computer networks. So, where does the magic happen? On online trading platforms. These platforms act as the bridge between you and the Forex market. Popular ones include MetaTrader 4, MT4, MetaTrader 5, MT5, and newer platforms like TradingView. These platforms provide tools for charting, technical analysis, and placing trades. They're user-friendly and accessible to anyone with an internet connection, making it super easy to jump into trading. Imagine this. You're sitting at your desk, sipping coffee and analyzing the USD-JPY chart on your laptop. You spot a trend and decide to place a trade. That's the beauty of online trading platforms. You can trade from anywhere in the world. What about choosing a broker? Now, let's talk about the gatekeepers of Forex trading. Brokers. A Forex broker is the intermediary that connects you to the Forex market. But here's the catch. Not all brokers are created equal. Choosing the right one can make or break your trading journey. So how do you pick a good broker? Let's break it down. 1. Regulation and safety. This is non-negotiable. Always choose a broker that's regulated by a reputable financial authority. For example, in the US, look for brokers regulated by the Commodity Futures Trading Commission, CFTC, or the National Futures Association, NFA. In Europe, check for regulation by CISEC, Cyprus Securities and Exchange Commission, or FCA, Financial Conduct Authority in the UK. Regulation ensures that your funds are safe and the broker operates transparently. Trading costs. Every time you trade, you'll encounter two main costs. Spreads. This is the difference between the buying ask price and the selling bid price of a currency pair. A smaller spread means lower costs. Commissions. Some brokers charge a small fee per trade in addition to spreads. Look for brokers with competitive spreads and low or no commissions, especially if you're just starting out. 3. Trading platform. Your broker's platform should be easy to use and equipped with the tools you need. Most brokers offer demo accounts, so take one for a test drive before committing. 4. Leverage. Leverage lets you control a large trading position with a small deposit. For example, with 1-to-100 leverage, you can control $10,000 in trades with just $100. While leverage can boost your profits, it can also amplify your losses. Choose a broker that offers reasonable leverage options and understands your risk tolerance. 5. Customer support. Trading happens 24/5, so your broker's support team should be available when you need them. Look for brokers with live chat, phone support, and fast response times. 6. Deposit and withdrawal options. Make sure the broker supports convenient deposit and withdrawal methods like bank transfers, credit cards, or e-wallets like PayPal. And check their processing times. Nobody wants to wait weeks to access their funds. So, here's the recap. Forex trading is all about trading currency pairs, major, minor, and exotic. Trading happens on online platforms, giving you access to a global market from the comfort of your home. Choosing the right broker is crucial. Look for regulation, low costs, good customer service, and a user-friendly platform. By now, you've got a solid understanding of the foundation of Forex trading. Ready to take the next step? Let's keep building on this knowledge and turn you into a confident trader. Chapter 3. How do you actually trade Forex? In this chapter, we're shifting gears from understanding the basics to the actual mechanics of trading Forex. Whether you're in the US or anywhere else in the world, it's crucial to know the rules, understand key trading concepts like lot sizes and pip values, and, most importantly, manage risk effectively. Let's get started and break it all down into actionable steps you can use today. Important information for US-based traders. If you're a trader based in the United States, there are a few key regulations and requirements you need to know. Forex trading in the US is highly regulated to protect traders and ensure transparency. Here are the main points. 1. Regulated brokers. In the US, Forex brokers must be registered with the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. Why does this matter? A regulated broker ensures your funds are safe, trading practices are transparent, and you're protected from fraud. Always verify your broker's registration with these agencies before signing up. 2. Leverage restrictions. In the US, leverage is capped at 150 for major currency pairs and 120 for minor or exotic pairs. This might seem restrictive compared to international markets, where leverage can go as high as 1 per 500, but it's designed to reduce the risk of massive losses. 3. Hedging is prohibited. U.S. regulations don't allow traders to open multiple opposing positions on the same currency pair, a strategy known as hedging. Instead, the FIFO rule, first in, first out, applies. This means if you open multiple trades on the same pair, you must close them in the order they were opened. 4. Tax reporting. Profits made from Forex trading are taxable in the U.S. Make sure to keep detailed records of your trades for accurate reporting during tax season. So if you're in the U.S., these rules might feel limiting at first, but they're designed to protect you and promote responsible trading. Lot size and equivalent pip value. Now, let's talk about one of the most fundamental concepts in Forex trading: lot size and pip value. If these terms sound intimidating, don't worry, we'll simplify them for you. What is a lot size? A lot represents the size of your trade or the number of currency units you're trading. Forex trading uses three main types of lot sizes. 1. Standard lot, 100,000 currency units. 2. Mini lot, 10,000 currency units. 3. Micro lot, 1,000 currency units. For example, if you're trading EUR/USD with a standard lot, you're trading 100,000 euro worth of currency. If you're using a mini lot, it's 10,000 euro, and with a micro lot, it's 1,000 euro. What is a pip? A pip is the smallest price movement in a currency pair. For most currency pairs, a pip is the fourth decimal place, a 0.001. However, for pairs involving the Japanese yen, it's the second decimal place, 0.01. How do lot size and pip value work together? The value of a pip depends on the lot size you're trading. Here's a simple breakdown for a currency pair like EUR/USD. Standard lot, 1 pip equals $10. Mini lot, 1 pip equals $1. Micro lot, 1 pip equals cents. Let's say you're trading a mini lot of EUR/USD and the price moves 10 pips in your favor. Your profit would be 10 pips, $1 per pip equals $10 profit. Why does this matter? Understanding lot sizes and pip values is crucial for managing your trades. It helps you determine how much money you're risking on each trade and ensures you don't over-leverage your account. Let's dive into that. Speaking of risk, information on risk management. Forex trading is exciting, but it's also risky. If you're not careful, you can lose money just as quickly as you make it. That's why risk management is one of the most important skills you'll ever learn as a trader. Tip 1. Don't over-leverage. Leverage is like a double-edged sword. It can amplify your profits, but it can also magnify your losses. Here's an example to illustrate this. Suppose you have $1,000 in your trading account and use 1/100 leverage. This means you can control a trade worth $100,000. A 1% price movement against your position would result in a $1,000 loss, wiping out your entire account in one trade. To avoid this, always use leverage conservatively. In fact, many experienced traders stick to leverage ratios of 1 to 10 or lower. 2. Use stop-loss orders. A stop-loss order is a tool that automatically closes your trade if the price moves against you by a certain amount. For example, if you buy EUR/USD at 1.1000 and set a stop loss at 1.0950, your trade will close automatically if the price drops to 1.0950, limiting your loss. Stop loss orders are your safety net. They protect your account from catastrophic losses and help you stick to your risk management plan. 3. Risk only a small percentage of your account per trade. A good rule of thumb is to risk no more than 1 to 2% of your trading account on any single trade. For example, if you have $1,000 in your account, you should risk no more than $10 to $20 per trade. This strategy ensures that even if you hit a losing streak, your account will survive long enough for you to recover. 4. Understand the risk-reward ratio. The risk-reward ratio is the amount of money you're willing to risk versus the potential profit you're aiming for. A common ratio is 1:2, meaning you risk $1 to potentially make $2. For example, if your stop loss is 10 pips away, your take profit should be at least 20 pips away. This approach ensures that even if you win only 50% of your trades, you'll still be profitable over time. 5. Keep emotions in check. One of the biggest mistakes traders make is letting emotions drive their decisions. Fear, greed, and impatience can lead to impulsive trades and unnecessary losses. Stick to your trading plan and trust the process. Remember, trading is a marathon, not a sprint. So how do you actually trade Forex? Here's a quick recap. 1. For US traders, understand the rules and choose a regulated broker that fits your needs. 2. Learn the lot sizes and how pip values affect your profits and losses. Start small, especially if you're a beginner. 3. Master the art of risk management. Use leverage wisely. Always set a stop loss and risk only what you can afford to lose. Trading Forex isn't about gambling. It's about making calculated decisions based on knowledge and strategy. Stick with these principles, and you'll be on your way to becoming a confident, disciplined trader. In Chapter 4, Fundamental or Technical Analysis, we're diving into one of the most debated topics in Forex trading: fundamental analysis versus technical analysis. These are the two main approaches traders use to make decisions in the market. Each has its strengths, and which one you use, or if you use both, depends on your trading style and goals. Let's break this down in a way that's simple, practical, and engaging so you can choose the method that works best for you. News and fundamental analysis. Let's start with fundamental analysis, which focuses on the bigger picture: economic events, news, and global trends. If you've ever heard about a central bank decision or seen headlines about inflation, you're already halfway to understanding this concept. What is fundamental analysis? Fundamental analysis involves evaluating the economic health of a country to predict how its currency might perform. This method focuses on key drivers like: 1. Economic reports. Reports like GDP growth, unemployment rates, and inflation are critical. For example, if a country's GDP grows faster than expected, its currency may strengthen. 2. Interest rates. Central banks like the Federal Reserve or the European Central Bank set interest rates. Higher interest rates often lead to a stronger currency as investors seek better returns. 3. Geopolitical events. Elections, wars, or trade agreements can cause significant market fluctuations. Keeping an eye on global events is crucial for fundamental traders. Using news for trading decisions. When you're trading based on fundamental analysis, you'll often look at an economic calendar, which highlights important events and their potential impact. Here's how to approach it. 1. Understand the event's impact. Some events, like a non-farm payroll, NFP report in the US, can cause massive volatility in the market. Know which events are high impact and prepare accordingly. 2. Forecasts versus actual results. Markets often react not just to the event itself, but to how the actual results compare to expectations. For example, if inflation is expected to rise by 2% but comes in at 3%, the market could experience a sudden spike. 3. Timing is key. Many traders enter or exit positions just before or after a major announcement. Be cautious, as volatility can lead to quick gains or significant losses. Example: trading with news. Imagine the European Central Bank announces a rate hike, signaling a stronger euro. If you're trading EUR/USD, you might decide to buy euros in anticipation of a rise in value. But remember, timing and understanding market sentiment are crucial. Technical analysis. Now let's move on to technical analysis, which focuses on charts, patterns, and price movements. If you're someone who loves visual data and numbers, this method is for you. What is technical analysis? Technical analysis assumes that everything affecting a currency's price, whether economic events, trader sentiment, or market speculation, is already reflected in the price chart. Instead of digging into economic data, you'll analyze. 1. Price charts. Charts are the bread and butter of technical analysis. They show how a currency pair has performed over time and help identify trends. 2. Indicators. Tools like moving averages, RSI, relative strength index, and Bollinger Bands help traders identify momentum, overbought, oversold conditions, and potential reversals. 3. Patterns. Patterns like head and shoulders, triangles, and double tops can provide clues about where the market is headed. Using charts and indicators. Here's a simple breakdown of how technical traders analyze the market. 1. Identify trends. Use a moving average to spot whether the market is in an uptrend, downtrend, or moving sideways. For example, if the price is consistently above the 50-day moving average, it indicates an uptrend. 2. Spot support and resistance levels. Support is where the price tends to stop falling, while resistance is where it struggles to rise. These levels are crucial for setting entry and exit points. 3. Watch for candlestick patterns. Candlesticks can tell a story about market sentiment. For example, a hammer pattern at the bottom of a downtrend might signal a reversal. Example, trading with technical analysis. Suppose you're looking at a EUR/USD chart and you notice a head and shoulders pattern forming. This pattern often signals a reversal. If it appears at the top of an uptrend, you might decide to sell EUR/USD, expecting the price to drop. Fundamental versus technical, which is better? Now comes the big question. Should you use fundamental or technical analysis? Advantages of fundamental analysis. 1. Helps you understand long-term trends and market direction. 2. Ideal for swing traders or long-term investors who can hold positions for days or weeks. 3. Allows you to trade based on real-world events and data. Advantages of technical analysis. 1. Perfect for short-term trading, like day trading or scalping. 2. Provides clear entry and exit points using charts and indicators. 3. Eliminates the need to follow every piece of economic news. Why not both? The truth is, many successful traders use a combination of both methods. For example, use fundamental analysis to identify which currency pairs are worth trading. Use technical analysis to pinpoint the best time to enter or exit a trade. Practical tips for beginners. 1. Start simple. If you're new, start with one method. For example, focus on technical analysis by learning how to read charts and use a few basic indicators. Once you're comfortable, incorporate fundamental analysis. 2. Don't overcomplicate. You don't need to know every chart pattern or follow every economic report. Pick a few tools or events that work for you and master them. 3. Practice on a demo account. Test both methods in a demo account to see which one suits your trading style. This way, you can experiment without risking real money. Whether you're drawn to the logical approach of fundamental analysis or the visual appeal of technical analysis, both methods have something valuable to offer. The key is to find what resonates with you and aligns with your trading goals. Chapter 5. Further information on Forex specifics. Some of the most crucial aspects of Forex trading that will help you make better decisions, reduce risk, and set realistic profit goals. We'll talk about the risk-reward ratio, the types of orders, and a question every trader asks at some point. How many pips is enough? This chapter is all about building a solid foundation for your trading plan, so let's break it down in a clear and engaging way. Risk-reward ratio, the key to long-term success. What is the risk-reward ratio? The risk-reward ratio is one of the cornerstones of successful trading. It's a simple way to measure how much you're risking compared to how much you stand to gain in a trade. For example, if you risk $100 to potentially make $300, your risk-reward ratio is 1 to 3. This concept ensures that even if you lose more trades than you win, you can still be profitable. How? By ensuring that your winners are significantly larger than your losers. Why is it important? 1. Consistency over time. You don't need a 90% win rate to succeed. A trader with a 50% win rate and a 1-to-2 risk-reward ratio can still be consistently profitable. 2. Emotion management. When you know the reward outweighs the risk, you're less likely to panic or make impulsive decisions. 3. Help set clear goals. It provides clarity on where to place your stop loss and take profit levels. How to calculate the risk-reward ratio. 1. Identify your stop loss. This is the maximum amount you're willing to lose on a trade. 2. Set your take profit. Decide how much profit you want to aim for. 3. Divide the risk by the reward. If you risk 20 pips to gain 40 pips, your ratio is 1.2. Practical example. Let's say you're trading EUR/USD. Your entry price is 1.1 thousand. Your stop loss is at 1.098 EO, risk of 20 pips. Your take profit is at 1.140, reward of 40 pips. Here, your risk-reward ratio is 1-2. This means you only need to win 1 out of every 3 trades to break even. Always aim for a minimum risk-reward ratio of 1-2. It gives you a cushion against losses while keeping your goals realistic. Types of orders. Controlling your trades. When you trade Forex, you're not just randomly buying and selling. You're using orders to control how and when your trades are executed. Let's break down the main types of orders you need to know. 1. Market orders. A market order is the simplest type of order. It executes your trade immediately at the current market price. When to use. When you want to enter or exit a trade quickly. Ideal for highly liquid pairs like EUR/USD or USD/JPY. Drawback. Slippage can occur, especially during high volatility, where you might not get the exact price you expected. 2. Stop loss orders. A stop loss order is your safety net. It automatically closes your trade if the market moves against you by a certain amount. Why it's crucial. Protects your account from significant losses. Removes emotions from the equation, ensuring you stick to your trading plan. Example. If you buy EUR/USD at 1.2 thousand and set a stop loss at 1.1980, your maximum loss is 20 pips. 3. Take profit orders. A take profit order automatically closes your trade once your profit target is reached. Why it's useful. Locks in profits without requiring you to monitor the trade constantly. Example, if you buy EUR/USD at 1-2 thousand and set a take profit at 120.40, your profit is locked at 40 pips. 4. Limit orders. A limit order is used to enter the market at a specific price. Example, if EUR/USD is trading at 1.2 thousand, but you want to buy it at 119.80, you set a limit order and the trade executes only if the price drops to 1.1980. Pro tip, always combine stop loss and take profit orders with your trades. This way, you manage your risk and reward automatically without letting emotions interfere. How many pips is enough? Now let's tackle one of the most common questions. How many pips should you aim for in a trade? The answer depends on your trading style and strategy. Scalping. What it is. Scalpers aim for small profits, usually 5 to 10 pips per trade, but they make multiple trades per day. Key consideration. You need a low spread broker, as tight spreads are crucial for scalping. Day trading. Day traders aim for 20 to 50 pips per trade and close all positions before the market closes. Key consideration. Focus on pairs with high daily volatility, like GBP/USD or USD/JPY. What it is. Swing traders hold positions for days or weeks, targeting 100 to 200 pips or more. Key consideration. This style requires patience and a solid understanding of both fundamental and technical analysis. Realistic expectations. It's essential to set realistic profit targets based on your experience, strategy, and the market conditions. Don't aim for 1,000 pips in a week as a beginner. It's not sustainable. Instead, start small and gradually increase your targets as you gain confidence. Use historical data to understand average price movements for your chosen currency pair. Pro tip. The number of pips matters less than your overall risk-reward ratio. Focus on consistency rather than chasing big wins. Putting it all together. So, how do these concepts work together in a trading plan? Let's break it down. 1. Set your risk-reward ratio. Decide how much you're willing to risk and how much you want to gain. Aim for at least 1-2. 2. Choose the right order types. Use stop loss and take profit orders to automate your risk management. 3. Set realistic PIP goals. Whether you're scalping, day trading, or swing trading, align your PIP targets with your strategy and risk tolerance. This chapter is all about equipping you with practical tools and strategies to trade smarter, not harder. The risk-reward ratio ensures you're managing your losses and maximizing your gains. Understanding different order types gives you control over your trades, and knowing how many pips to aim for keeps your goals realistic and achievable. Chapter 6. Trading Psychology. Let's talk about the mental game of trading, a topic that separates successful traders from the rest. You might have the best strategy in the world, but if your mindset isn't strong, your chances of consistent success are slim. This chapter dives into the key psychological aspects of Forex trading, including discipline, patience, and emotional control. Let's break it down step by step in a way that not only informs, but also inspires you to take control of your trading journey. Why is trading psychology important? Trading isn't just about charts, indicators, or news. It's a mental battlefield. Your emotions, fear, greed, frustration, and even overconfidence can cloud your judgment, leading to mistakes. Understanding and mastering your mindset is critical because 1. The market doesn't care about your emotions. The Forex market moves based on global factors, not your feelings. You need to adapt to it without letting emotions dictate your decisions. 2. Consistency is key. Success comes from sticking to your trading plan, even when emotions try to pull you in different directions. Discipline, the foundation of success. What does discipline mean in trading? Discipline in trading is the ability to stick to your plan no matter what. It's about following your rules for entry, exit, risk management, and not deviating because of emotions or impulses. How to build discipline. 1. Create a clear trading plan. Write down your rules for every aspect of trading, from risk management to specific setups. A plan keeps you accountable. 2. Avoid overtrading. Many traders, especially beginners, feel the urge to trade constantly. Discipline means waiting for high probability setups, even if it means sitting on the sidelines for hours or days. 3. Stick to your risk management rules. Never risk more than you can afford to lose. A disciplined trader knows when to cut losses and walk away. Pro tip: treat trading like a business, not a hobby. Would you make impulsive decisions in a business? Probably not. Apply the same level of seriousness here. Patience, waiting for the right opportunity. Why patience is crucial. The Forex market operates 24/5, and it can be tempting to jump into trades constantly. But successful traders know that waiting for the right opportunity is far more rewarding than chasing every small movement. How to practice patience. 1. Wait for confirmations. Don't enter a trade just because the market is moving. Wait for your technical or fundamental signals to align. 2. Avoid revenge trading. After a loss, it's easy to feel like you need to win back what you lost. Patience means accepting the loss and waiting for the next high-quality setup. 3. Trust the process. Remember, Forex trading is a marathon, not a sprint. You don't need to make money every single day to be successful over the long term. Pro tip: think of the market like fishing. You don't jump into the water and grab the fish. You patiently wait for the right moment to reel it in. Emotional control, mastering fear and greed. Fear. Fear often shows up as hesitation. You might see a perfect setup but freeze, thinking, what if I lose? This hesitation can cause you to miss opportunities. How to manage fear. 1. Use a stop loss. Knowing you have a safety net reduces fear. 2. Start small. Trade smaller lot sizes until you build confidence. 3. Focus on the process, not the outcome. Fear often comes from focusing too much on money. Shift your focus to executing your plan correctly. Greed. Greed can lead you to overtrade, hold on to positions too long, or take excessive risks. It's the voice in your head saying, just one more trade, or I'll double my account today. How to manage greed. 1. Set realistic goals. Avoid aiming for massive profits in a short time. 2. Take profits when planned. Stick to your take profit levels instead of trying to squeeze out every last pip. 3. Learn to walk away. After a successful trade, resist the urge to jump back in. Pro tip: balance is key. Fear and greed are natural, but they shouldn't control your actions. Acknowledge them, but stick to your plan. Tips for developing a winning mindset. 1. Keep a trading journal. Write down every trade, including why you entered, how you felt during the trade, and the outcome. Reviewing your journal helps you identify emotional patterns and improve over time. 2. Set achievable goals. Instead of focusing on making a certain amount of money, aim to execute your plan perfectly or stick to your risk-reward ratio. 3. Take breaks. If you're feeling frustrated or emotionally overwhelmed, step away from the screen. Sometimes the best trade is no trade at all. 4. Learn from losses. Every trader experiences losses. Instead of dwelling on them, analyze what went wrong and use it as a learning opportunity. 5. Practice visualization. Imagine yourself executing trades calmly and following your plan. Visualization can help you develop a confident and disciplined mindset. Common psychological traps to avoid. 1. Chasing the market. Jumping into trades because you feel like you're missing out often leads to losses. Stick to your plan. 2. Overconfidence after wins. A winning streak can make you feel invincible, leading to over-leveraging or risky trades. Stay grounded. 3. Focusing only on money. While profits are important, focusing solely on them can lead to impulsive decisions. Instead, focus on the quality of your trades. Final thoughts. Trading psychology isn't just an add-on to your strategy. It's the glue that holds everything together. Discipline keeps you grounded, patience helps you wait for the right moment, and emotional control ensures you don't sabotage your success. Remember, the market is unpredictable, but your mindset doesn't have to be. Master your emotions, and you'll be well on your way to becoming a confident, consistent trader. Now, let's move on to the next chapter and take another step toward your trading goals. Chapter 7, Time to Trade. Now that you've got the basics of Forex trading, it's time to focus on one of the most critical decisions you'll make. How do you want to trade? In this chapter, we're diving into day trading versus longer-term trading and why keeping a journal or diary can transform your trading game. Let's get into it. Day trading versus longer-term trading. Day trading, fast-paced, high action. Day trading is all about making quick moves within a single trading day. You open and close trades in hours or even minutes, aiming to profit from small price movements. Who is day trading for? You thrive in fast-paced environments. You're comfortable analyzing short-term charts like 1-minute or 5-minute intervals. You have time to actively monitor trades throughout the day. Advantages of day trading. 1. No overnight risk. Since you close all trades by the end of the day, you avoid unexpected market gaps or news impacting your positions overnight. 2. Frequent opportunities. With so many movements happening during the day, there are plenty of chances to profit. 3. Quick feedback. Your results are immediate, helping you refine your strategy quickly. Challenges of day trading. 1. Time commitment. You need to be glued to the screen during market hours. It's not for the part-time trader. 2. Emotional stress. The rapid pace can lead to emotional highs and lows, especially if you're chasing trades. 3. High transaction costs. Frequent trades mean higher spreads and commissions, which can eat into your profits. Longer-term trading. The art of patience. Longer-term trading involves holding positions for days, weeks, or even months. This strategy focuses on bigger trends and broader market analysis. Who is longer-term trading for? You prefer a calmer, less intense trading environment. You have a full-time job or other commitments. You enjoy analyzing daily, weekly, or monthly charts. Advantages of longer-term trading. 1. Less screen time. You don't need to monitor the market constantly, making it ideal for those with busy schedules. 2. Lower transaction costs. Fewer trades mean less money spent on spreads and commissions. 3. Bigger profit potential. By riding larger trends, you can capture significant price movements. Challenges of longer-term trading. 1. Overnight risks. Holding trades overnight exposes you to unexpected news or market gaps. 2. Patience required. Waiting for trades to play out can test your resolve. 3. Fewer trades. Opportunities are less frequent, so you need to make each one count. Pro tip: there's no right or wrong choice between day trading and longer-term trading. The key is to pick the style that matches your personality, time availability, and goals. Keeping a journal or diary. All right, here's a game changer that most traders overlook: keeping a trading journal. Trust me, this habit can take you from an average trader to a pro-level one. Why is a journal important? 1. Track your performance. A journal helps you see what's working and what isn't. 2. Identify patterns. Are you consistently losing trades during specific times or currency pairs? A journal will highlight these trends. 3. Emotional awareness. Writing down how you felt during each trade can reveal emotional triggers affecting your performance. What to include in your journal? 1. Trade details. Date and time of the trade. Currency pair. Entry and exit prices. Lot size and pip gain loss. 2. Reason for the trade. What setup or analysis led you to enter the trade? 3. Outcome. Was it a win or a loss? And more importantly, why did it turn out that way? 4. Emotional notes. How did you feel during the trade? Were you anxious, confident, or impulsive? Understanding the emotional side of your trades can help you spot patterns in your behavior that affect decision-making. 5. Lessons learned. Write down what you learned from each trade, win or loss. Did you stick to your plan, or did emotions drive you to deviate? This is the key to improving over time. Benefits of keeping a trading journal. 1. Objective reflection. Sometimes it's hard to see your mistakes in real time, especially when emotions are involved. Looking back at your journal allows you to objectively analyze your decisions. 2. Improvement over time. By reviewing past trades, you'll notice patterns in your trading strategy that either work or need adjustment. This is the fastest way to refine your approach. 3. Boosting consistency. A journal helps you track your progress and stay disciplined, which is essential for consistency in trading. It's your roadmap to success. Pro tip: make journaling a non-negotiable part of your routine. The best traders know that tracking their trades is one of the most valuable tools in their toolbox. Conclusion: making the right choice for you. Now that we've broken down day trading versus longer-term trading, it's important to remember that there's no one-size-fits-all approach. The right strategy for you depends on your time availability, risk tolerance, and, most importantly, your personality. If you're someone who thrives in a fast-paced, action-packed environment, day trading might be your best fit. If you prefer a more relaxed, less stressful approach and have the patience to wait for bigger moves, longer-term trading could be the way to go. And no matter which path you choose, keeping a trading journal will elevate your trading journey. It's not just about the trades. It's about learning, improving, and becoming the best version of yourself as a trader. Chapter 8, Conclusion. All right, traders, we've made it to the final chapter. If you've stuck with me this far, congratulations. You've learned the foundational steps to start your journey into the world of Forex trading. Now, let's wrap it all up and review the key lessons that will set you up for success. Key lessons from the book. 1. Understanding Forex trading. Forex is simply the exchange of one currency for another. It's a 24-hour market filled with potential. You've learned that Forex trading is much more than just buying and selling. It's about comparing one country's currency to another. 2. Choosing the right currency pairs. You discovered the difference between major, minor, and exotic currency pairs. Understanding what these pairs mean and how to choose them is vital for making informed trading decisions. 3. Picking the right broker. You've learned the importance of choosing a reliable Forex broker. A good broker can make a huge difference in your trading experience, so do your research and pick one with strong reviews, good customer service, and a solid platform. 4. The importance of lot sizes and pip calculations. We broke down lot size and how it affects your position. Understanding pip value and how to calculate it will ensure you're not overexposing yourself to risk. Number 5. Managing risk like a pro. Risk management is the backbone of successful trading. We explored how to manage leverage, set stop-loss orders, and use the risk-reward ratio to protect your capital. 6. Fundamental versus technical analysis. The battle between fundamental and technical analysis is real. You've learned how both strategies offer different perspectives. Fundamental analysis lets you track economic events and market news, while technical analysis focuses on price patterns, indicators, and chart setups. 7. Trading psychology. One of the most critical lessons is about mindset. Trading is 90% mental, and we dove deep into the importance of discipline, patience, and controlling your emotions. Successful traders know how to keep their heads cool in the face of market chaos. 8. Choosing your trading style. Day trading or longer-term trading. We broke down the differences and showed you how each approach fits different types of traders. Whether you're into fast-paced, quick decisions, or prefer waiting for larger trends, the choice is yours. 9. The power of a trading journal. We can't emphasize this enough. Track your trades. By keeping a journal of your entries, exits, emotions, and lessons learned, you'll continuously grow and improve as a trader. This simple habit will keep you grounded and help you spot areas for improvement. If there's one thing to take away from this book, it's that Forex trading is a skill, one that requires knowledge, practice, and most importantly, the right mindset. You don't need to be a genius to succeed in Forex, but you do need to be disciplined, patient, and willing to learn from every trade, whether you win or lose. Remember, successful traders don't trade impulsively. They follow a well-thought-out plan, stick to it, and improve their strategy over time. The journey ahead is exciting, but it's not without challenges. But if you stay committed and keep learning, you're setting yourself up for long-term success. So, whether you're just starting out or already dipping your toes into the market, keep your head in the game, stay patient, and never stop improving. The world of Forex trading is yours to conquer, and you've got everything you need to make it happen. Bonus section: Trading System, Insights, and Management. In this bonus section, we'll dive into some practical strategies that can help you take your trading to the next level. We're talking about a trading system, entry signals, trade management, and a bit of the author's personal take on trading. Let's break it down. Trading System Introduction: a practical system with templates and custom indicators. Now, a trading system is like a roadmap. Without it, you're just guessing where to go. A good system will guide you through the chaos of the market and keep you on track. The beauty of this system is that it's customizable. It's designed with templates and custom indicators to suit your personal trading style. How does the trading system work? Templates. These are pre-built setups that you can follow. They make it easier to execute your trades without overthinking. Custom indicators. These are tailored to help you spot key trends and price movements. By using the right indicators, you can get clear signals of when to enter or exit a trade. Key takeaway: a trading system helps you make decisions based on logic, not emotions. And by using the templates and indicators, you're stacking the odds in your favor. My thoughts on trading. Insights from the author. Now, let's hear the author's perspective on trading practices, what they've learned from years of experience. What makes a successful trader? 1. Discipline. It's not just about having the right strategy, but sticking to it, no matter what. Successful traders don't chase every opportunity. They wait for the right one to come along and execute their plan with precision. 2. Patience. This is a game of waiting. You can't rush it. The markets move at their own pace, and the best traders know that trying to force a trade is a recipe for disaster. 3. Consistency. Trading isn't about hitting it big once or twice. It's about consistent, small gains. Think of it like compounding. Small, steady wins over time add up to big results. 4. Learning from losses. Losing is part of the game. Successful traders view losses as lessons, not failures. Each loss teaches something valuable that helps refine their strategies and improve their next move. Key takeaway: trading isn't about luck. It's about applying sound principles, following a strategy, and learning from every single experience. Entry signals and trade management. Guidelines for identifying entry points and managing trades effectively. The hardest part of trading is knowing when to get in and when to get out. That's where entry signals and trade management come in. If you can master these, you'll be ahead of the game. Identifying entry points. An entry signal is the precise moment you should open a trade. It's based on your system's indicators and the overall market trend. Here are some common signals. Breakouts: when the price breaks above a key level of resistance or below a support level. Reversals: when the price starts changing direction after a trend. Trend confirmation: when all your indicators align, confirming the trend is strong and likely to continue. Key tip: don't enter a trade without a clear signal. Entering too early or too late can turn a good trade into a bad one. Managing trades effectively. Managing your trade after you've entered is just as important as entering in the first place. Here's how to stay in control. Stop loss orders. These protect you from large losses by automatically closing your position if the market goes against you. Take profit orders. Set your profit-taking points before entering the trade. This removes the temptation to hold on to a trade too long and risk giving back profits. Trailing stops. This helps lock in profits as the price moves in your favor. The stop loss automatically adjusts to a higher price as the trade becomes more profitable. Key takeaway: once you're in a trade, it's all about managing your risk and profits. Use stop loss and take profit orders to create a safety net. And remember, never risk more than you can afford to lose. To wrap it up, this bonus section has given you some powerful tools to boost your trading strategy. A solid trading system helps you navigate the markets with confidence, and understanding entry signals and trade management ensures you're not flying blind. And as the author shared, it's all about discipline, patience, and learning from experience. So take these tools, refine them with your personal touch, and get ready to approach trading with a plan. Consistency and risk management are your keys to long-term success. So always stay focused and stay disciplined. And that's a wrap for today's video, traders. I hope you found this guide on Forex trading insightful and that you're ready to apply these tips and strategies to your trading journey. If you enjoyed the content, don't forget to like this video, share it with your fellow traders, and subscribe to the channel for more in-depth trading tips and strategies. Drop a comment below if you have any questions or thoughts. You know I love hearing from you. Thanks for watching, and as always, stay patient, stay disciplined, and keep trading smart. Catch you in the next one.